Starting the recording. Okay, so I will discuss two. So I that I had given you in the last class. Unfortunately, I've forgotten to bring the book. I still have some one or two of the problems, but let me just go through a little bit of the module, and if I have time, then I'll return to national income and discuss the problems today. Otherwise, I'll discuss it in the next class, hopefully on Monday. And Monday also, I'll discuss the individual assignment. Okay. So, yeah, is the screen visible?
Yes, sir.
Yes, sir. Yes,
Okay,
sir.
okay. So the second topic module that we are going to cover is the introduction to macroeconomic variables. So we are going to focus on three types of variables. In fact, one of the variable, of course, you have already discussed, that is national income. But apart from that, there are other variables which are of interest to economists and policymakers. And this is money, inflation or prices, and unemployment. Okay. Now let's start with money. Now, what do we mean by money? Well, the standard definition is that money is any generally accepted medium of exchange. So, we had different types of money before. I mean, you know that we had gold coins earlier. Even now, if you go to the ornament shops, you will get guineas, gold guineas. But we had other types of money also. You had cowrie shells. You had, uh, I don't know. I mean, if you just Google money or types of money, you're going to get a whole range of very peculiar commodities which had served as money in the past. If you look at the POW camp, the war camps during the Second World War, POW means prisoner of war. So the Germans had captured the Allied soldiers and they used to keep them in POW camps. In those camps, do you know what served as money?
No, sir.
Cigarette.
Cigarettes. Cigarettes was the common form of money in the POW camp. So I'll post this paper to you in the Google class, the economic organization of a POW camp, where, I mean, it's just for reading. You can see how even a POW camp where you didn't have any money, or how the economy was set up within such camps. Now, why do we have money? I mean, we can directly see money by itself is generally useless. I mean, if you don't consider gold coins, if you don't consider the cigarettes, then if you take the 500 rupee note, 2000 rupee note, what's it? Is basically nothing. It's just a scrap of paper. So why do we have this money? See, one reason is that money was preceded by barter system. So in case of barter, you had a situation like this. Let us suppose you have A. Let us say A has a goat Sorry, just a minute. It's not functioning properly. And no, I have to close the paint and start again. Okay. So let us say A has several goats and he wants rice so that he can make biryani. Okay. Now B has rice and he also wants goat because he also wants to have biryani for lunch. So what can happen is these two people can meet and A will give B some goats and B can hand over A some rice. So you have barter without any money coming into being used. Now barter has two problems. One is double coincidence of what? See, in this case it's very easy to come to a transaction, or relatively easy. But suppose you have a situation like this, that A wants rice, he has goats, B wants goats, but he has not rice but cows. C wants cows, and he has, let us say, milk. And D wants milk, and he has rice. So how will trade occur? A will have to go to B and get goats from him. No, he has cows. So after the cows, he will go to C, give the cow, get milk, then again go to D, give him the milk, and get the rice. So how many transactions, how many persons does he have to approach? He has to approach 3 persons. Whereas in this case, he could just go to B and get the money, his commodity from him. So if you want barter to be successful, you have to have two conditions. One is A should want a commodity that B has, and A should have the good or commodity that B wants. Okay. This is called double coincidence of wants. If you have double coincidence of wants, nothing is better than barter. You can quickly transact without bringing money into without using money. But as I've shown in this example, we generally don't have double coincidence of wants, so transactions takes a long time. The second problem is, what will be the exchange rate? See, rice, and he's giving away goats, okay, and he's getting cows. So, see, you can't have a one-to-one exchange. Goats are much smaller, cows are much larger, and they should be valued, have a higher value. So, you can, first of all, you have to fix up the exchange rate. How many goats for one cow? How many cows for milk? It will be an awful lot of milk. And how much milk for rice? Sorry. So fixing up the exchange rate can become very problematical, and it's going to be very difficult, because I can say that, look, this goat is a stout fat goat, but this goat is very thin goat, so I want two such thin goats. So exchange rate can, I mean, even if you determine an exchange rate, you can't really apply it to all transactions. You will again have to start the process of bargaining with the person. And the third problem is that suppose we have fixed up an exchange rate like this: two goats is equal to one cow. Okay, so this means that if you want to give up a cow, you're going to get two goats. But suppose you want only one cow, one goat. In that case, what will you do? Will you give him half a cow? Well, obviously, it's not possible. So, the divisibility becomes a problem. Okay. If you want half of the commodity, 3/4 of a commodity, it becomes very difficult to transact. So, for this reason, money was introduced into the economy. We can have limited legal tender or unlimited legal tender. Do you know what is limited legal tender or unlimited legal tender? Right? What is the difference between, oh god, okay, can you hear me now?
Yes,
Yes,
sir.
sir.
Okay, wait a minute, I'll have to start the screen sharing again. So, you have heard of the problem, right? Right, between, what are the problems with barter?
Yes, sir.
So, just to repeat, in case you have, I don't know when I got disconnected, you require double coincidence of wants, you require the problems in fixing up exchange rate. This has to be fixed up for every transaction. And third is, commodities may not be divisible. Okay. Okay. Now, what is the difference between limited and unlimited legal tender? Can anyone guess what is the reason, or what is the difference?
Sir, legal tender means money, right?
Yes. So once money came in, instead of transacting between commodities, you simply sell it and he gives you money. Using this money, you can buy from as much as you want from any other person.
Sir, limited legal tender, I mean, does it mean the notes that we have, and unlimited means the checks? Because here we can transact for unlimited amounts. Is it like that?
No. Limited,
Sir,
yes,
limited legal tenders are like coins of very lower
denomination.
denominations, like 0.50 or something like that. And unlimited legal tender are something that has to be accepted by everyone, like notes and coins of higher denominations, like 10 rupees or 5 rupees.
Okay, you're from Delhi board, right?
Yes, sir, from ISB board.
Yeah. So, see, legal tender means anything which can be tender. Tender means that you're giving, offering. So, it's anything which can be offered legally in exchange for goods and services. Okay, in case of limited, you can only offer a certain amount. You can't pay the entire amount using coins, for instance. Coins are limited legal tender. Unlimited legal tender is that you can offer any amount and the other person has to accept it. So, for instance, suppose you purchase something which is 1000, you go to a shop and purchase a television set, and you say that, look, I brought the money, but it is in coins. You have 25 paisa coins. Well, the person can refuse because it is limited legal tender. But if you give 500 rupees or 100 rupees, it's unlimited legal tender that has to be accepted. Okay? Now, if you look into the money, does anyone have okay, let me see if I can show the money. So, by the way, this is only for academic purposes and I don't mean to violate the copyright. Wait a minute, I just want to show you something. Yeah, this one. Yeah, can you see this money at the 100 rupees note at the right hand side? Yeah, can you see this note?
Yes, sir.
Yeah. So what you have over here is, if you see, look at the writing over here, I promise to pay the bearer the sum of 100 rupees. And you have C. Rangarajan's signature. He's the governor of RBI. So that means and this is guaranteed by the central government. Okay, the Reserve Bank issues is guaranteed by the central government. So that means, see, this is just a piece of paper, but it is similar to a check in the sense that if you take it to the Reserve Bank and say that I don't want this money, they will give you 100 rupees of, well, I don't know what they will give you 100 rupees, but it should be 100 rupees of gold. You are supposed to get 100 rupees worth in exchange for this note. Am I clear? So you will see that
Is
in,
it 100 rupees of gold? I did not understand.
see here it is given, can you see this writing over here? I promise to
Yes,
pay the
sir.
bearer the sum of 100 rupees. So that means once you take it to the Reserve Bank and say that, okay, I don't want this note, they are legally bound to, the central government is guaranteeing that the Reserve Bank will give you 100 rupees worth gold.
That means we
Generally it's
can
gold.
go and take 100 rupees notes and get back gold.
Now gold will be worth 100 rupees. So it's a very small quantity. That is the theoretical concept. behind this statement. Okay. In case of the 500 rupee, I promise to pay the bearer the sum of 500 rupees. So you will get gold worth 500 rupees. So this is actually what is done legally. Well, you are supposed to, if you take the money to the central bank, you are supposed to get this amount. But in reality, most money has now become what is called fiat money. Fiat money is that if you take the money to the central bank, they will not give you anything in return. They will just laugh at you and tell you to go off, run off. Okay. So fiat money is basically worth nothing. It's just worth the paper. It is the only value of this fiat money is because all the entire society believes that accepts this as money, accepts that this has the value of this piece of paper is 100 rupees. Yes.
That means this fiat money is been in the market only after the government or RBI has given its authority for that money, na?
Government has given the
For the money for money to be circulated in the economy. This paper, means RBI has printed. That's why we're using it, na?
yeah, RBI has printed. Someone may print it. That's not a problem. We often have private
Means
individuals printing it also.
that is illegal, sir.
Yeah, that is true. But anyway, yeah. So
Sir, I couldn't get the concept of the fiat money. Sir, means you told that it doesn't have any value, but it is
no, what
considered
I'm
as.
saying is that earlier, see, money is just a piece of paper, right? Your 100 rupee note, 500 rupee note, 200 rupee note, it is just worth the piece of paper. Your coin is different. You can melt the coin and get back some value. But rupee note, is it worth anything? It is just
No,
paper
sir.
which is almost valueless. The value is, in case of, normally or previously, it is something like a check, you can say, or a promissory note. It is a promise by the central government or the central bank that if you take the money, they will give you 500 or 100 amount of gold. That is why money has a value. Is this part understood?
Yes, sir. I
This is a
understood.
okay. The rest, the student who raised the earlier question about printing. Have you understood? And if you're typing, I can't see what you're typing, by the way.
Sir, I don't know who asked about that printing part, sir. I asked,
হ্যাঁ ঠিক আছে
sir,
তোমারটা
what the concept of fiat money. Fiat money
আচ্ছা
বুঝিনি, sir.
then see, this was the system before. Now the system is the central bank will no longer honor the promise. So if you go to the central bank or reserve bank, they will no longer pay you 100 or 500 rupees of gold. Is that clear? So that means what is the
Yes, sir.
value of money? The value of money is simply because all of us are accepting it.
Hello,
Uh,
sir.
Yes.
So, at the time of demonetization, the older money we can say that it is a fiat money.
It is not a fiat money. Now it is everything has become fiat money. Fiat means the promise is no longer valid. Okay, is it clear now?
Yes.
So in that case, the value of this rupee note, 100 rupee, 500, 50 rupees, it is simply because all of us are accepting it. So suppose a group suddenly gets up and says, look, the Reserve Bank has made it fiat money, we will no longer accept it. In that case, transactions will come to a stop. So that is why this part of the definition. Any generally accepted, it has to be accepted by the entire society. If people say we don't accept it, money is going to become valueless. And the second part, medium of exchange, it is used for exchange of goods and services. Instead of barter, we exchange using money. Okay. So this was the general definition, but we also have some technical definitions, which is called M1, M2, and so on. We have got 4 M's. Acha, by the way, by currency I mean both the coins and I also mean the notes. Is this clear? Okay, so M1 is defined as the currency with the public plus demand deposits with the banking system. What are demand deposits?
Fixed deposit.
These are savings deposits, savings or current account deposits. So you can go to the bank and demand that, okay, you return me the deposit. And fixed deposits are called term deposits. You make them for a period of time. Fixed and recurring are term or term deposits. They have a associated time. So that means you have told the bank that, look, you keep this money for 5 years, and if you need the money before 5 years, you will have to pay a penalty. Okay, so currency with the public, demand deposits with the banking system, and any other deposits that the banks make with the Reserve Bank. In case of M2, we add in the deposits with the post office savings banks. Is that clear? In M3, we take M1, okay, so it's currency with the public, demand deposits. Now we also add term deposits, or time deposits. So all types of deposits with the central bank and cash money is part of M3. And M4 is M3 plus post office savings bank. So M1 and M3 includes only the banking system. M2 and M4 includes the post office also. Okay. So in brief, M4 can be said to be currency with the public and all deposits either with banks or with post offices. Is it clear? Now, what are the
Sir,
functions?
can you show the slide once more? Okay.
Yes.
This one?
Yes, sir.
হয়ে গেলে আমাকে একটু বলো প্লিজ।
Sir, under the category of other deposits with RBI, sir, mainly what sort of deposits? I mean the repo and all those things. Like are those the deposits with the RBI, which the banks give?
See the, sorry, just one minute please. See, the bank can keep certain deposits with the Reserve Bank. I mean, they can keep their excess money with the Reserve Bank. So if they are borrowing something, if they have excess reserves, see, banks have to keep a certain amount of what they have with the Reserve Bank. Okay, this is called,
Yes, sir, CRR,
sorry,
cash reservation ratio. Sir, CRR, cash reservation ratio. That one.
cash reserve ratio is no, that is different. But they have to keep a certain amount with the RBI. That is called, that is part of other deposits.
Acha, acha. Okay.
Okay, so the main difference between M1, M2 and M3, M4 is over here whether you will include time deposits or not. If you include time deposits, it becomes M3 or M4. Clear?
Yes, sir. Time
And
the deposits means the current ones, right?
time
That
deposit হচ্ছে deposits which you have kept with a time.
oh, FD, মানে
Fixed
uh,
deposit,
fixed
recurring
deposits, yeah,
deposit.
and recurring. Okay, okay, sir. Now understood. Sir, is there any organizational difference between the post office savings banks and the normal banks, or they are same?
I'm afraid I don't know the answer. I think they will be, they are not under the Reserve Bank.
Acha, acha, sir.
Okay, I hope this makes it even clearer. So M1, M2 versus M3, M4, the difference is whether you include term deposits or not. And M1, M3 versus M2, M4 is whether you include post office savings banks or not. That is the main difference. Currency is always included in money. Okay.
Sir, I'm done right now.
Okay. Achha. But remember one thing, when you're taking M4, the national savings certificates are not included. Do you know what NSCs are?
Sir, I have heard the term from
But
my
you don't
father,
know.
but
Okay.
I don't know.
Okay.
I just heard about it.
So
Sir,
national,
sir,
yes. Huh.
so just like the government give us one, we need to give money to the government, and they provide us one agreement that we can use it as anytime as a money also in banks also, and after 3 years with interest, the government will give us the money back. It's just like one of the certificates.
Yeah. So it's a certificate. You deposit money for a certain period. Unlike fixed deposit, in case of NSC, the period is given. So you cannot decide how long to keep it. In bank, you can go and ask that, okay, I want to keep it for 5 months. I can keep it for 10 months, 2 years, like this, depending on your need and rate of interest. In case of NSC, they will give you, they will say that, okay, you have to keep it for 7 years. I think now the period is 7 to 8 years. You have to keep it. You cannot withdraw it. Only at the end of the period, you can return the savings certificate to the post office and get the money. So NSC is not liquid. Liquid means anything which can be converted to cash very easily. So savings account can be converted to cash easily. You just go to the bank, or now you can just withdraw money from the using the ATM card. Term deposit is slightly more difficult, because the banks will give you the money, but you will have to pay a penalty. And NSC you cannot redeem earlier. You have to wait till the period is over. The only thing you can do is you can take a loan against NSC. Is it clear? So NSC is not included within M4.
Now I understood, sir.
Now, what are the functions of money? I'm sure that those who are Delhi board remember this rhyme. Money is a matter of functions for a medium, a measure, a standard, a store. So, what is a medium of exchange? It is something which is used for the purpose of exchanging commodities. That is the primary function of money. Instead of directly exchanging, you sell it to someone. So you have a commodity X, you sell it to someone who has X. With the money, you directly go to someone who will send you Y, which is what you want. You don't have to undertake several transactions. Next is means to measure. Now, what do you think is more costly? Uh, a large watch or a small or your hand wristwatch?
Sir, it depends. Like if we buy a normal Ajanta watch, then it may cost about 300. But if we get a good wristwatch, then it may cost even 30,000. Right. So it really depends which type of watch it is.
Yeah, of course. But suppose you're buying a standard watch,
Acha.
intermediate.
Yeah.
In
Then
general, what
yeah.
will be more costly?
So the clock, wall clock, because it is a bigger one, I think.
My
Wristwatches are expensive.
no, there's a
Sir,
very
it depends on marketing copy.
no, there's a very famous story that the person goes to buy the watch and he selects a wall clock and he asks what is the price. He says that the shopkeeper says that it's worth 20 rupees. It's before independence. So he said 20 rupees. No, I want a cheaper watch. So he selects a watch which is smaller. And he says, what is the price of this? He says, this is worth 30 rupees. Then, no, 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 not 30. I'll buy a even smaller watch. He said, the price is even more, 40 rupees. So, anyway, so in case of watches, generally the price varies inversely with size. The wall clocks are worth about 200, 300, but a good standard wristwatch will be much more costly. But anyway, what the important thing is, how can you say that which commodity is cheaper, which is costlier? You are expressing the value in terms of rupees. You are saying that this is 300 rupees, this is 400 rupees, this is 600 rupees. So you know which is costly and you know what is the difference in value. So suppose something is worth 400, something is worth 200 rupees. You say it is worth, the second item is worth half of the first item, right? So it provides a measure. Third is that if you go for barter, okay, you go out to the person and say that, look, I have some cows with me. I would have brought it to in the market, but bringing a cow is very difficult. It will run away. So I'll sell you the cow, and you have to give me such and such commodity. Will the person accept?
No, sir.
Why?
There is no guarantee.
Yeah.
Yeah, there's no guarantee that you're going to bring the cow, and even more, there's no guarantee how the cow will look like. Maybe it is so sickly that it's going to die if you bring it to the market. So what will happen is, you cannot defer your payment. You have to pay or complete the transaction immediately. Okay, even if you have seen the cow, you have brought the cow, you say, I'm going to see the cow, the cow is very fond of me, so I can't give it today. You come next week and I'll give you the cow. Okay, so you have seen what the cow is, you know its value, but you cannot defer the payment. No one will accept it. But in case of the money, I mean, why will he not accept it? Because the value of the commodity may deteriorate. The cow may die. If it's a perishable item that you are selling, suppose you are exchanging bread and something else. If you agree to pay the bread after 7 days, is it worth anything? After 7 days, the bread will become stale. Okay, so its value will go down. But if you pay by money, will the value of money go down? You have
No,
agreed
sir.
to pay 1000. Unless there's a inflation, the value will remain same. So instead of paying today, he can pay you the promised amount after 1 week. It's still, you still get 1000 rupees. And fourth is store of value. You have the money, so and you can use it as an asset. So you have the ability to purchase 500 worth commodities. If you keep the money with you, after 1 week, you still have assets worth rupees 500. But in case of biscuits, for instance, or in case of bread, you have brought a lot of bread. After 1 week, what will happen? All of it will become valueless. Right? So, money is something which helps to exchange. It is something which we use to measure the value of commodities. You can use it to defer your payments, and you can use it as a store of value. So, your value remains, you can use it later on. Now, credit creation. How do you create money? Of course, as one of you has pointed out, the Reserve Bank or the central bank prints the money. But how is it brought into circulation? See what happens is that suppose you are a businessman and you go to the bank and you ask for a loan of 100 rupees. So you go to bank A and you ask for 100 rupees. So the bank will give you 100 rupees. They will not give you this 100 rupees by cash. What they will do is, they will open an account in your name, and they will deposit 100 rupees in this bank, in this account. Is this clear? Achha.
Yes, sir.
You can withdraw this money whenever you want. So, depending on how your business runs, you can withdraw the money today, tomorrow, next week, so on. Achha. Now, the bank knows that although you have the right to withdraw the money completely, you're not going to, it's highly unlikely that you're going to withdraw the entire money. Based on experience, it's based on two things. One is experience. They know that you're going to withdraw this amount of money. Okay. And second is, they also know that there are going to be some people who are going to deposit money. So suppose you want money which the bank doesn't have. At that point, someone else will come up and deposit money. So using this deposit, they can pay you. Okay. So what the bank normally does is, they keep a certain amount of this cash with themselves. How much? It depends on what the Reserve Bank says, and also based on experience, on the expectations. So let us say that they keep 20% of the money with them, and the remaining 80%. So if you want, you can come out and collect the money. The remaining 80 rupees is again lent out. So out of the 100 rupees you have lent, banks have kept 20 rupees for them in case you are coming and asking for the money, and 80 rupees is now lent out to another person. So this person opens an account in, let's say, B. B will also keep 20% as reserves and lend out the remaining amount, 64. So this 64 is deposited in bank C, 20% is kept over here as reserves, the remaining 80% is lent out, and this goes on. So how much deposits has been created with this 100 rupee note? 100 rupees plus 80 plus 64 plus 5120 and so on, like this. Right. And you can see that the deposit too is going up. So if you add up this entire amount, you are going to get the total amount of deposits. So you had only 100 rupees, but how much have you created as deposits? You have created, if you add them up, you will see that you have created an total deposits of 457. Okay. Now if you look at it, let us suppose this 100 is kept over here. So this is the amount C. Now this is the amount that has been deposited over here. Now how much is lent out? 1 minus CR into C, right? This is the deposit in bank B. You're keeping 1 minus CR proportion with you and you're lending out the remaining portion. So 80% of C is going to be lent out, right? In the second
Yes, sir.
period, in the third period, let's go to this.
Sir,
Yeah,
sir,
bolo bolo.
I think CRR value got
20, 20%. Give me 0.20. So you have got 100 rupees, that is deposit. In the second period, 120, sorry, into CR, this is the deposit. In the third period, what is the deposit? This is the deposit. Right? So it is 100. Sorry, I wrote CR over here. It should be 100 actually. So this is 100 and this becomes square. So what will be the third term?
Sir, are you writing something?
Yeah,
Yes, sir.
can't
Are
you
you
see it?
writing? No,
No,
sir.
sir.
We can't see.
Okay.
Actually, the screen has frozen at a place. Just the PowerPoint presentation is being shown.
Okay, I don't think I shared the screen. I shared the presentation. Yeah, now can you see it?
Yes, sir. Now you can see.
Okay. Okay. Okay, so the first deposit was 100, right?
Yes, sir.
Out of this, this is the amount that is deposited in bank B, right?
Yes. Yes, sir.
How much is deposited in bank C?
1 minus 0.65
This into,
into 100.
right? So I can write this as 100. This is 0.2 into 100. Now I can take this square. In the third case, it is how much? This entire thing.
Yes, sir.
So it is 1.02 1.02 into 100, right? So this
So
is,
basically a GP.
it is forming a GP, which is
Sir,
infinite.
one doubt I have here.
Yes.
So, as it is forming a GP, so the reason behind it, which you already told, sir, can you repeat once more? Like, for the first bank, the amount deposited is 100 rupees. For the
Yes.
second bank, it's 1 minus 0.2 into 100.
Hmm.
And for the third bank, it is 1 minus 0.2 whole square into 100. Like, first bank to second bank to third bank, how is this coming? Like, why this 1 minus 0.2 is being multiplied every time? Like, I understood the CRR, like
Okay, okay, okay,
20% is being
okay, okay.
deposited.
Okay, first let's solve the problem and then I'll come back and explain it.
Okay, sir. Okay.
Acha. So we have a GP. This is the common term. So what is the formula of this GP?
So 100.
Say 105.
Sorry. I'm keeping the 100 over here.
Yeah.
And
Say it
this.
will be 1 by CS.
Okay, so this is the formula. Acha. So that means this is the total amount of deposits that has been created. So if I want to find out the total deposits, the change in deposits, this is equal to 1 by CRR into my additional loans. How much loan or how much money I have added into the economy, and this is the total the change in deposits. So this is the increase in loans, this is the increase in money or deposits. Okay. So you can see that if you increase DL by 1 unit, your total money supply will go up by more than 1 unit. Is this clear? So this is called
Yes, sir.
a money multiplier. Okay, and it is defined as 1 by CRR. Now coming to a question that why is the deposit increasing in this way? Wait a minute, let me rub it out. Okay. Okay. So bank X1 goes to bank A and he gets 100 rupees. Now what the bank does, he does not give the money to him. He opens a savings deposit account and deposits the money over there. So it is 100, right? Now in a savings account, theoretically you can withdraw the entire money, you can keep the entire money, you can withdraw part of it. But the bank knows that you are generally people do not withdraw more than 20%. Okay. So, although the bank has given you 100 rupees, the bank knows that you are not going to withdraw more than 20 rupees from this, right? So, banks, how much
So,
will, yes?
so the 100%, is it the money that I deposited in the bank, or
No, this is the money that Bank A gave you the loan.
Acha, so
They
bank is
give you
giving
the
me the
loan,
loan of 100 rupees.
yes.
Yeah.
What they do is they open the account and give it in your an account in your
Yeah.
name and deposit this money.
Yes, sir.
Okay, we actually it's not a savings deposit, we call it a loan account.
Okay, sir. And sir, then what about that 20% you told? Can you repeat?
Achha. Now from the loan account you can withdraw any amount. You can withdraw 10 rupees, 20 rupees, 40 rupees, 50 rupees, 100 rupees, right? But
Yes, sir.
generally people do not withdraw more than 20 rupees. Okay.
Okay, okay.
Banks have observed this over time. If your habit changes, then they will, instead of 20%, they will revise this cash reserve ratio. Is it clear?
Yes, sir.
Okay.
It's
So
clear.
this 20% I'm just using as an example. It can be higher, it can be lower. Okay. Now suppose if banks keep the money with them in the locker or vault, they are not going to earn anything from it. How will banks earn? They will lend out and get
Yes, sir.
interest on it, right?
Yes, sir.
So if you have kept 100 rupees with them, banks will do two things. They will keep 20, 20% of 100 in case you withdraw this amount, right? And what they can do is they can loan out the remainder. Have you understood this?
Yes, sir.
So how much can
Sir,
they loan?
sir, 1 minus 0.2 into 100.
Okay. Acha. So this is the amount that they have loaned out. Okay. So let us say they have loaned it out to X2. So that means X2 has a loan account in that bank, some other bank. Right? Now what will happen?
Yes.
Again banks will follow this. They will keep 20% of this in case you withdraw it.
Yes, sir, one thing. Sir, this 1 minus 0.2 into 100, this amount is being loaned to an individual, right?
Individual, firm, does it matter?
No, sir, I'm just asking about this one. When you are telling that on this amount, 1 minus 0.2 into 100, another 20% is being deducted and kept in this very same manner. Sir, how is it reaching the second bank that I'm asking? Like,
That
what is the relation between
okay,
for
okay,
them?
it's in bank A. It's in bank A. ঠিক আছে?
Okay.
So what happens is they have opened an account for X2. Now what is the amount in X2's account? This amount. So 20% of this is kept, okay, in case he
Yes, sir.
withdraws it. And how much is lent out? Right?
Yes, sir.
1.02 into loan to X2. And what is this? What is the loan to X2? It is how much? 100. Right?
Yes, sir.
Acha. So this is loan to X3. So X3 has a loan account, and if I square this, I'm going to get 1.02 whole square into 100. So 20% is kept with the bank, and the remaining 80%, sorry, it should be point, right, is loaned out. This is the loan to X3. So what is this? This is simply this part. So it now becomes cube. So it will go up to 4, 5 and so on. Is it clear now?
Yes, sir.
Okay. Now I have come back to the slide. So in this way, if you lend out 100 rupees, you are actually going to create money not equal to 100 but a much higher amount, equal to 400. Roughly over here it is shown 457, but you can find out the exact amount using the formula. So the money created is equal to 1 by CRR into the loan amount. Okay. Now if the money supply increases, this can lead to certain problems. On the other hand, if money supply decreases too much, that also has certain problems. I mean, businessmen don't get enough funds to invest and run their business. So the central bank has to control the credit very carefully. It has to manipulate or decided, okay, this is the optimal amount of credit. If the actual credit falls below this level, they will have to encourage or push up or create more credit. If you have an oversupply of credit, you have to reduce the credit amount, right? So if there's excess credit, you go for credit contraction. And if there's a shortage of credit, businessmen are not getting funds, you go for credit expansion. Okay. Now what are the means for doing this? How does the Reserve Bank control credit? They have two main types of instruments or main types of policies. One is quantitative credit control and the other is selective credit control. Quantitative is general. So that means in case of quantitative, you control the total volume of credit in the economy. Okay, in case of selective credit control, you control credit going to a particular sector. And this is the total volume of credit in the economy. Fine? Achha. Now in case of quantitative credit control, you can use the bank rate. See, what is a bill of exchange? A bill of exchange is very often in trade, you don't actually, when you purchase or order a commodity, you don't actually send the money. What you do is you write down a document or guarantee that, okay, I'm going to pay you 5 lakh rupees after 6 months. This is called a bill of exchange. Okay, so after 6 months, you take the bill of exchange and you go to the person who has issued it and he will give you this 5 lakh rupees. Acha. Now suppose I have issued you a bill of exchange and you suddenly need the money urgently. In that case, you can go to the bank and say that, look, I need this money. Zede sir had told me that he's going to pay me 5 lakh rupees after 6 months. But I need the money now, so please give me the money and you take this bill of exchange. You take the money from him. So the bank will accept it, but what they will do is they will deduct a certain percentage, which is called the bank rate. So they will say that, okay, out of every 100 rupees, I'm going to deduct, let us say, 5%. So suppose you take a bill of exchange of 100 rupees, they will give you 95 and 5 will be bank will keep. That is the service they are holding on to the money. Okay. So if you increase, see, if you get 95, that means you are given some money. This adds to the money supply in the economy. Now, how can you control the volume of money supply? Suppose you increase bank rate. Then out of this 100 rupees, you are getting only 90 and 10 the bank is keeping. So this leads to credit contraction. Okay. On the other hand, you can reduce the rate further to 2.5. In that case, what happens? The amount, the credit that is created increases. So you have credit expansion. Is it clear?
So can you repeat the last part after the 3 types?
মানে ব্যাংক রেটের ব্যাপারটা?
Yes, sir.
স্যার
ইয়েস।
স্যার বলছিলাম ব্যাংক রেটের আন্ডারে কি আপনার কি বলো ওটা
বলো।
স্যার ওই ব্যাংকটা রেপো রেট রিভার্স রেপো রেট কি পড়ে না ওটা আলাদা?
আমাকে একটু দেখে বলতে হবে। হ্যাঁ, রেপো রেট এগুলো দিয়ে তোমার ক্রেডিট কন্ট্রোল হয়। আচ্ছা, see, what is a bill of exchange? First try to understand that. Suppose we have entered into a transaction and I'm purchasing commodities from you, 100 rupees worth commodities. Instead of paying the money immediately, I can give you a bill of exchange. This bill of exchange states that after 3 months, I will pay 100 rupees to you. Is it clear?
Yes, sir. Bill of exchange
Achha.
is clear.
Okay. Now the problem is that after 1 month, you suddenly need the money. Right?
Yeah.
If you come to me, I don't have the money with me. I've told you earlier that I will get the money after 3 months and I will pay you then. I cannot pay you earlier. So what will you do? You will go to the bank and you will surrender this bill of exchange, and in exchange you are going to get some money. Okay, now when you give the bill of exchange, the bank will charge a certain amount. So they will not give you 100 rupees. They will deduct something and give you the remaining amount. How much the rate at which they deduct, that is called the bank rate. So that means if the bank rate is 5, the bank will keep 5 and they are going to lend you 95.
Yes, sir.
So how much credit has been created?
95.
95. Achha. Now suppose you increase the bank rate. So when you go to the bank with another 100 rupees, what will the bank say? They will give you how
So they will
much?
charge the higher rate.
They will give you only 90 rupees.
Yeah.
So again, credit has gone up, but has, compared to the previous case, has it gone up more or less?
So the credit has decreased. It was previously 95, now it's
Now it is
90. So
90.
yeah.
Acha, but if you if you lower the bank rate, make it 2.5.
So then the credit has again increased to
Yeah.
97.5.
So in this way, they can either contract credit or expand credit.
Yes, sir.
Acha. Next is open market operations. See, the Reserve Bank can sell government bonds in the open market. Suppose the Reserve Bank sells government bonds and all of you purchase the government bonds. What will happen to the money supply
It will
with
decrease, sir.
the public? It is going to decrease because the Reserve Bank has taken away all your money. Achha. If the government buys bonds, what will happen? The money flow is from
The money will increase.
Reserve Bank to the public. So, money supply increases. Third is the cash reserve ratio, which you can understand. If the cash reserve ratio goes up, money supply is going to fall, credit contraction, and vice versa. Statutory liquidity ratio is that the bank has to keep a certain amount with the Reserve Bank. So if the bank keeps a certain amount with the Reserve Bank, what happens is, suppose the banks have 100 rupees. Okay. So they will keep, let us say 5 rupees so that they can meet withdrawals. So if you come and ask for the 100 rupees for some money, they can give you this money. The SLR is kept with the Reserve Bank in case there's some emergency, and the remaining amount is loaned out, and this expands credit. So if you increase SLR, what will happen to this amount? Out of 100 rupees, can you lend out more or less?
Less.
Yes, you can. Your capacity to lend out falls. On the other hand, if your Reserve Bank lowers the SLR, your capacity to lend will increase. So money supply, credit will go up. Selective credit control is fairly easy. I'll discuss the second and third earlier. Quota is, the Reserve Bank simply says that if farmers want loan from you, don't give more than 5 lakhs. That is a quota. So you give 1 lakh to some person, 2 lakhs to some person, 5 lakhs is over, you stop lending. Moral suasion is, the Reserve Bank gives you some instructions. It's not legally binding, but banks will follow the instructions. Third is the marginal requirement. Marginal requirement is, see, if you want loans, you will have to keep some of your assets. There's a possibility that you are not going to repay your loan. Okay. So you have to keep certain financial or real assets with the bank. In case you don't repay the loan, they will take away all these assets. This is called mortgage. So in case of mortgage, what the banks basically do, they fix a margin. That okay, if you are lending for, suppose your asset is worth 100 rupees, we will lend you up to 80% of your asset. Okay, this is called the marginal requirement. So suppose the marginal requirement is increased, that means for the same asset you can borrow more, credit will go up. If this marginal requirement is lowered, for the same asset you can now borrow less, and you are going to have credit contraction. Now, why are we so worried about credit? The reason is inflation, the relation to prices. See, inflation is defined as persistent rise in the general level of prices. So, I've referred to price indices, and these price indices tends to go up. Now you can measure, see, you have prices of different commodities. So what we generally do is we combine all the information. So we have prices of, let us say, P1, P2, n number of commodities. So all this is combined to form a price index. So this combines all the information. Okay, if this index uses price of all commodities, then it is called headline inflation. Now food prices and fuel items are very volatile. So we can drop these two items and calculate the price index. That is called core inflation index. Now, what is the price? I mean, if you look at price of rice, for instance, you have two prices. One is the price that you are paying, but this is called the retail price. The other is the wholesale price. So if you go to the mandi, the district markets, the price will be lower over there. That is called the wholesale price index. You purchase huge amounts, tons of rice. And in case of consumer, you buy small quantities. So the price index can use either the wholesale price or consumer price, and accordingly you get WPI or consumer price index. You also have the agricultural labor price index, where items normally consumed by agricultural workers are used. Okay.
So that can last piece cover.
Sir, what will be the reference for this part?
See, M1, M2, M3, M4, you can get from any other, from the internet.
Okay, sir. So, is there any good book for this topic? Then we can see for that. Is there any? I mean, otherwise we'll refer the internet only. It's okay.
Yeah, I mean, see, this is, I mean, it's basically class 10, class 12 stuff.
Yeah, that is also true. Yeah.
Yeah, so I don't know. I don't think you'll get it in a graduation level book. Maybe in some of the
Acha,
past
okay, okay.
course books. I don't know.
Okay, sir. Okay, sir. Got it.
Acha. Cost of inflation I'll cover later. Causes of inflation. You can have two types of inflation. See, look over here. The red line is the supply curve, and the green line is the demand curve. Okay, this is the price axis, this is the quantity axis. What is you can see that the price is set by the interaction of demand and supply curve. So you can see that price is going up. Now, why is price going up? Over here. Price is going up because the demand curve, aggregate demand curve, is shifting outwards. Right? We call it a demand pull inflation. Alternatively, you can have shifts in the supply curve. So in this case, you have cost push inflation. The cost of production, the cost of producing this item is increasing over time. So the supply curve shifts leftward or upwards, whatever you say, and price also increases. In reality, however, it's not very easy to distinguish between demand pull and cost push inflation. Okay, it becomes mixed up, because one cost goes up, you are going to have demand rises. This can lead to a scarcity in the input market, and you will have cost push inflation. So it's a bit difficult. Theoretically, it's very easy. Practically, it's difficult. Okay, I think
So
I'll.
can you show the last slide?
Which
Yes, sir. So the right, top right one is demand pull. No?
this is demand pull, and this is cost push.
Okay, sir.
You can also have markup inflation. See, suppose labor is the only input. See, price sometimes. See, SM has taught you a theory of prices, right? Has she, by the way, has she covered perfect competition?
Yes, she started. Yeah, she covered the perfect competition. Yeah.
Okay, so you know that price is set by the interaction of demand supply, and it is equal to marginal cost, right? You
Yeah, yeah.
set price to
We
maximize
got that.
profit. The problem is that very often you don't know what is your marginal cost, marginal revenue price. So you can't really uh, equate MC to MR. In such cases, we follow some rule of thumb. One is markup pricing. What you do is you estimate the average cost, roughly, and then you set a certain percentage above this. So you fix up on a market 10%, you want a 10% profit. So if your cost is 50 rupees, 10% of 50 is 5, so you charge a price of 5. If your markup is 20, you increase the price to 60. Okay. So suppose labor is the only input. In that case, what is the labor bill? WT into NT, this is the labor bill. XT is the output. So wage bill by output, you're getting the average cost, and this is the markup. M is the markup. We are writing 1 plus M because M is in percentage terms. Okay. So markup, if the markup for some reason is revised, this can also lead to inflation. If you have very unstable conditions, firms can suddenly start revising their markup upwards. M goes on increasing. In that case, again, price will fall. Price will rise. Okay. So I think I'll end at this point, so that you can all go and have lunch, tiffin, whatever, depending on where you are.
So can you show the last slide, sir? Markup inflation.
Okay, have you finished?
Yes, sir.